Derivatives. Imagine you own an airline. Every day, thousands of flights take off. Your biggest expense is fuel. Today, oil costs $70 per barrel. But what if 6 months from now, oil jumps to $120? Your profits could collapse overnight. You need certainty. So you make an agreement today with an oil supplier. No oil changes hands right now. Instead, both sides agree on a price that will be used 6 months in the future. Now, whether oil goes to $120 or falls to $50, both sides already know the price they'll use. The interesting part is that the value of this agreement changes every time oil prices move. If oil prices rise sharply, the agreement becomes more valuable to the airline. If oil prices fall, it becomes more valuable to the supplier. The agreement itself has value, but the value comes entirely from the oil. Without oil, the agreement means nothing. This is the core idea behind a derivative. A derivative is a financial contract whose value is derived from another asset known as the underlying asset. The underlying asset could be almost anything: a stock, a gold, oil, a currency, an interest rate, even an entire stock market index. Think of derivative as a side agreement built around an asset. You are not necessarily buying the asset itself. Instead, you are creating a contract whose value depends on what happens to the asset in the future. This is why it is called a derivative. Its value is derived from something else. The big idea: stocks, bonds, gold, and oil are assets. A derivative is a contract whose value comes from those assets. If the underlying assets changes in value, the derivative changes in value as well. That's the entire foundation of the derivative market.